Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're talking about the cannabis sector, touching both on HITI but also the sector more broadly. Now this is not something which I've seen discussed much at all, but is really important and something which every investor in the cannabis sector should be considering as part of their investment strategy. Before we get into it, please smash the like button. In our battle against clickbait on YouTube, when you do like the video, it's so helpful in letting the algorithm know that it doesn't only need to recommend the clickbaity misleading videos. It's massively appreciated, it really helps out the channel, so thank you so much. If you're new to the channel, make sure you're subscribed, and if you want to see more content, want to see other things, then check out the Patreon. As always, I'm not a financial advisor, this video is purely for educational and entertainment purposes only, but let's get straight into it. So, there's a phenomenon currently in the cannabis sector, which is not something which is seen in many other sectors where there is a commodity exposure. It's quite unusual and is likely to evolve over the coming months and years. This is the dynamic of the producers of the commodity product being valued more highly than the retailers or other value-add players in the value chain. Now, to quickly clarify here, I'm talking about valuation on a relative basis, so enterprise value over revenue or enterprise value over EBITDA where that's relevant. Now, I say where that's relevant because not all the producers are profitable at an EBITDA level. So I'm talking about valuation on a multiple basis, i.e. each dollar of revenue generated by a grower is more highly valued than the retailers. Now, I'm saying this for the avoidance of doubt before somebody makes the point that the reason a market capitalization or an enterprise value for growers is higher than for retailers is because of size. So we're talking relative valuations. Think valuation multiples here. So just to make it super clear, and sorry if I'm flogging a dead horse here, but I'm just keen to make sure it does not get misunderstood. So looking at the MSOs and LPs, the average LTM last 12 months enterprise value over revenue multiple is around 15 times. That means that on average, investors are valuing each dollar of revenue earned by these companies at $15. Comparing this to the retailers, the average multiple here is around 7.3 times, meaning that each dollar of revenue is only valued by investors at around $7.30. Now, more importantly, this average is significantly driven up for the retailers by Planet 13, and in fact High Tide is valued at around 3.4 times revenue, so for each dollar of revenue it generates, investors value this at $3.40. Now, this on its own is not unusual. Different players in the value chains of various sectors do have different valuations, and there can be a many number of reasons for this. However, the interesting dynamic here is that it is the producers which are valued more highly than the retailers. Now, in other sectors where there is commodity exposure, and yes, the cannabis plant is a commodity, and while there can be some differentiators, on the whole, the price is a function of supply and demand dynamics. In commodity markets, producers typically have the lowest valuation multiples. Now let's look at some other sectors, for example, which have matured and where that dynamic has stabilised. Let's think about the coffee sector, for example. Producers of the coffee bean are valued at much lower valuations than the retailers who provide the value-added service and who are able to differentiate themselves further. Think of the coffee farmers in Brazil versus Starbucks. For those arguing now that this is perhaps a function of geographical positioning of the commodity producer, let's think about alcohol. Much of the grain and hops and other ingredients in alcohol are grown in the US, Europe and across many more economically developed countries. Still here, the growers of these products are valued much less than the producers of alcoholic beverages, say Diageo or ABI. Now this is a trend which is observed across most developed sector chains. Lithium miners and battery manufacturers, silicon miners and chip manufacturers, tobacco farmers and tobacco giants like Philip Morris, the list goes on. The phenomenon currently in the cannabis sector is the reverse. But why may this be the case and what does it mean for investors in the cannabis sector? Now, before diving into this answer properly, it's important to explore why this dynamic is observed in other markets and whether the cannabis producers are an anomaly in this regard. In very simplistic terms, commodity producers are price takers. The revenue that they can generate for a unit of their product is a function of supply and demand. They have very little ability to control their revenue aside from increasing production. Are there ways that a commoditized product can add value and can escape this dynamic somewhat? Well, keep this in mind because we will come back to this. Now, with limited control over the top line, the only way producers can increase their profitability is through cost control and greater efficiency. This is a challenging dynamic and ultimately does create a dynamic where scale is key for the producers and those with the largest scale being able to operate most efficiently and capitalize on economies of scale and in turn driving greater profitability. Contrast this to the retailers or to the value-add players in the value chain. Incremental revenue can be driven through increased pricing and things like effective branding. Think about an entry-level vodka brand, for example, versus a super premium brand. The difference in cost between manufacturing the two products is actually fairly limited, but the pricing difference is enormous. This enables much higher margins to be generated by those manufacturers, giving them greater ability to control their profitability. They are the price makers rather than the price takers. Are there reasons for the difference in this valuation that may cause this phenomenon to be maintained as the market matures, or is this something which will likely reverse? Now, fundamentally, I believe there are three core reasons why this phenomenon currently exists. We will discuss each of these in turn, but quickly they are regulation, some differentiation of products, and the lack of retail investing opportunities in cannabis. Now let's start with regulation. Producers of cannabis do require regulation to do so, which is always good to see in companies which you invest into. It is also a barrier to entry, and there is a cost and challenge associated with new participants entering the market and thus making the model more defensible. Although, the key question here is, does that premium valuation, is it justified versus the value add players in the sector? At this point in time, that remains unclear to me. However, this does not limit the fact that they are still price takers, and the price remains a function of supply and demand. Now next up, let's discuss the ability to differentiate the product somewhat, and slightly being able to drive pricing more. I'm not talking here in relation to specific strains to generate greater yield, as this is something which happens across all grown commodities, but specifically here I'm talking in relation to Cannabis 2.0 products, things like oils, tinctures, vapes, drinks, edibles, all of these different products which will enable them to create brands and differentiate the product slightly in order to generate superior margins. I do think this is an important dynamic here and could indeed be a real reason for this dynamic in the market. It still needs to play out as the market matures, but it in effect would enable them to step away from being purely price takers. Not entirely, but partly. Now this is something which will develop over time and is something which we should definitely, as investors into the cannabis sector, keep an eye on. Now the final piece of the puzzle to discuss here is the lack of opportunities for investors to invest into cannabis retail. Now this should not be discounted at all. Until earlier this year, there were no NASDAQ listed opportunities to invest into cannabis retail. HITI's NASDAQ uplisting presented the first opportunity for this, and while the leader in the market in terms of scale, it is still a small player and it still has no physical US brick and mortar presence yet. Now, whilst I don't have a crystal ball, my belief is I think we will see this phenomenon disappear somewhat as the sector matures and evolves. My honest belief is that the long-term dynamics for the market within the market are that we will see some M&A-led consolidation amongst the largest producers, and long-term I do think we will see some compression of their current multiples. But I still do think that they will stay at a premium to other commodity sectors where there's not the ability to differentiate the product in any way and where there isn't the same regulatory overhang. I also expect to see the multiples of retailers grow and surpass that of the producers in the long run. As discussed, these are the companies that have the greatest opportunity to help differentiate and command premium pricing, especially those with a strong online footprint like HITI, which can capitalise on the global market opportunity more readily than others. Now this won't happen overnight, it won't happen this year, but this is my expectation for the long-term dynamics of the sector over the coming decade. As I've said before, I don't have a crystal ball, but I'm a firm believer that HITI is well positioned to benefit from this trend. One final point, and this is something which I say all the time, but be patient. If the dynamics discussed here are not things you believe in, if the time frame which is discussed is not something which works for you, then this may not be a suitable investment for you. Investing is a very personal thing. It's not a one-shoe-fits-all thing, and there's no right or wrong answer. You know your personal situation best, so make your investing decisions with that in mind. Anyway, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel, then make sure you're subscribed. Check out the Patreon group for more information and exclusive content. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.